Hey guys, this is Nick from Financially Aware. It's Sunday night and Softbank shares are down about 7% in Japan because of the news that they are the options whale that caused a melt up in the NASDAQ, and investors are a little jittery about it. So in this video, I'm going to try to piece together what happened, what Softbank did, kind of why they did it, and how smaller investors help them along in their plan, and what possible outcomes could we have from what's going on right now, because they still are holding these big option positions as well as pretty big stock positions that they bought. Now, if you don't know much about Softbank, they've been around like 40 years. They started out small. They're in telecom. And their claim to fame basically was they invested in Yahoo in 1996 and created Yahoo Japan, which made them a lot of money. And then they were really famous for, in 2000, they invested $20 million in Alibaba. And by 2014, when they went public, their stake was worth $60 billion. So that's a 3,000 times return on their money. So they have a huge venture capital fund that funds all kinds of startups and unicorns and all kinds of stuff. And so they have some hits and they have some misses. And most recently, they've been kind of taking some hits. They invested big in WeWork, and that IPO was canceled, and now, the valuation of WeWork is in the garbage because of people not going into offices and all that, and they had problems even before that. They also invested a whole bunch in Uber and some other ride-sharing companies which are not doing well. So they have had taken a few lumps, and the reason I'm telling you this is because they have a venture fund with like $100 billion in it, and apparently they've been wanting to do a second venture fund. So here in Zero Hedge, they say Masayoshi Son felt the need to spark this massive ramp, especially at a time during August when the markets are sleepy, because his reputation and credibility was crushed after WeWork and Wirecard, which they also invested in Wirecard, which was in the news recently about the fraud and all of that, because he has revived ambitions to secure tens of billions of dollars in fresh outside capital after the bombing of their second vision fund. So they tried to do a second private capital vision fund, and they didn't get the kind of commitments for money that they were expecting, because their performance hasn't been that great lately. So according to this article, part of the reason for what they did with these stocks was kind of to show that he has a remarkable return on these new investments in these public FAANG stocks. So it says here, the founder has said in May that Softbank was unlikely to secure outside investors for a second vision fund after problems with the first. And here, Bloomberg reported in mid-August that Softbank's investments were made using financing structures that can prevent Softbank from showing up in public records as a direct shareholder, because they want to hide their footprint. And also, in their latest quarterly report, they said they revealed that they established an investment management subsidiary whose purpose was to manage excess cash and diversification of assets, which would consist primarily of highly liquid publicly listed stocks, where investments would either be direct or via derivative transactions, which means options and things like that. So the gist of it is that they loaded up. Here's their report on ending June 30th. They loaded up on about $4 billion in all of the biggest NASDAQ stocks. And so these stocks represent about 40% of the NASDAQ index, the moves, the market cap of the NASDAQ index. Amazon, Alphabet, Adobe, Nvidia, Tesla, DocuSign, Netflix, Microsoft, 10x Genomics. So that's about $4 billion worth if you add up all of these positions here. Now, after they bought those stocks, they went and loaded up on options on those stocks and some others, spending $4 billion in options, which means that spending $4 billion in options, they had about $50 billion worth of stock that they controlled from those options because of the leverage factor in the options. And so as of right now, supposedly, those trades netted them about $4 billion in trading gains from those bets. So basically they spent $4 billion by running up the options, which made the dealers short gamma. I'll talk about that later. And so it made the market go up higher. And so they're sitting on a $4 billion trading profit. However, how they get out of that, it may not be so easy. So the reason they bought those stocks and then bought those particular options is because the market is getting concentrated in very few names. Just like in the S&P, the top 5 stocks make up like 25% of the market. In the NASDAQ, it's very similar. So by concentrating on just those couple of stocks that make up the large percentage of the NASDAQ and buying options in those, they can really goose the market and really pour gasoline on the market to the point where buying those options is kind of like the tail wagging the dog. So, and helping them with that is the smaller traders, the so-called Robinhood type of traders that are buying one contract here, one contract there. It adds up to a lot, and the volumes that they've been putting up lately have been going through the roof. So that also adds fuel to the fire. Here you see the options volume as a percent of shares volume. So it's now above 100%, where options volumes trade more than the actual share volumes for those underlying stocks in 2020. I mean, look how much it's gone up from like 20% in 2010 to over 100% now. And here's a look at the percent of small trades in options. Back in January 19, it was like 1%. Now it's like 13%. And the small trades, meaning one contract option trades, make up 30% of the volume in Chipotle, Google, Shopify, Booking.com, Tesla, Amazon, all these. And that's for one contract trades. Now, if they increased it to say, looking at say 2 contract trades or 3 contract trades, which are still small, those percentages may go up to 50%. So what this is saying is all these small guys are, with their one contracts, are piling in to the small number of the biggest names in the NASDAQ. And so it's a very concentrated effort to boost these things up all at the same time, while Softbank is also doing that. So while the volume for the options traded has increased, so has the increase in trades for options that have less than 2 weeks to expiration. And why is that important? Because the small traders buy a lot of these because they're kind of like a lottery ticket. They're really cheap. The premium is really cheap. And if the market booms up a lot, as they are optimistic that it will, then they could turn into multi-100% gains. So if you're buying deep out of the money options, let's say Tesla's at 450 and you buy a call at 500, it's 50 points away. So the option might be very cheap and it expires in 2 weeks, so it has very little time premium. So that option will be very cheap. And so the dealers that sell the options are short those calls, and they don't expect that they're going to expire with any value to them. But then when SoftBank comes in and bids these things up, and Tesla and Salesforce and all these other things spike up 2-3 standard deviations from where they normally do, all of a sudden those options are in the money now, and the dealers are short those options, and so they have to buy back stock to cover that risk that they're taking. So just to show you how broken everything is, this is the VIX at all-time levels, at all-time highs, okay? So right now we're in the 20s, reaching all-time highs, which is similar back to March 2000 when we were reaching all-time highs. The VIX was at high levels. Normally the VIX goes high as the market goes down, but because SoftBank has been buying all these options, they've been increasing the volatility, and so it's been spiking up like crazy. So all of this results in a gamma squeeze for the dealers that had to sell them their options, because the dealers sold these calls to SoftBank and all the other small traders, and so they are short calls, and so they have to hedge their calls, and that is being short gamma. And the way short gamma works is that as the stock prices go up, the options go up, and they have to hedge their short calls by actually buying more underlying stock. So it's kind of a feedback loop that just increases the pain for the dealers. The higher the stock goes, the higher the option goes, the more they have to buy back stock, which makes the stock go higher, which makes the options go higher, which makes their losing position on their short calls also increase. So it's kind of complicated, but that's kind of the gist of it. So there's a lot of uncertainty on how this is all going to unfold. Who's going to win out? Who's going to lose out? Is it going to be the dealers? Is it going to be SoftBank? Is it going to be the little guys as usual, or some combination of all of that? Is SoftBank going to go bankrupt or something like that? That's a big no. This is a kind of small position for them, and they are basically bank stopped by the Japanese government, so they're too big to fail. They may make some money on this, they may lose some money, but either way, it's not really gonna be that material to them. Maybe to their reputation a little bit if they get a lot of negative news about what they did here and how big of a distortion it is, and maybe they may be blamed if the NASDAQ continues to fall a good portion from here. I don't know what's going to happen, but it's definitely going to be interesting to watch. So I hope you liked this video and learned a little bit more about what's going on in the markets right now and who the players are and kind of how they're all interconnected here. If you like this video, give me a thumbs up and leave me a comment and subscribe to my channel if you haven't done so. Thanks for watching.